So today we'll do some math, not trigonometry, not calculus, but some basic financial math that comes up on a daily basis. For example, if you had your money invested in an investment that gives an annual rate of return of 8% per year, how long will it take for your initial investment to double? Or on the flip side, if you owed money to a credit card company and the APR or the annual percentage yield was 25%, how long will it take for the amount of money you owe the credit card company to double? That is the flip side, okay? Welcome back to another episode of the MD Investor. And all month, February 2024, we're doing Black Wealth. And this is part of our financial education. So today we're going to be studying about the rule of 72. So today we'll be learning about the rule of 72. Some of you may have heard of it already, some of you may have not, but it is a very practical formula to calculate how long will it take your investments to double, or how long will it take for the money you owe to double. That's the flip side of compound interest, okay? We want to be financially educated, right? We're not always going to have a calculator available with us there or a spreadsheet or anything like that, but we always have our mind, and it's a quick way that we can just kind of evaluate opportunities. One of the big things that comes up in terms of investment is how long will it take for my money to double? That's what people want to know. How long will it take for my initial investment to double? So we want to be able to intelligently analyze opportunities and compare apples to apples. How long will it take for my initial investment, my principal, to double is a major question that investors will have. That's how you can compare one investment to another and say, okay, how much more time will it take this one than this one? Okay, because we all have a limited amount of time, right? Okay, so the rule of 72 simply says to find out how long will it take for your investment to double, you take 72 and you divide it by the rate of return that you're getting. So if we're getting a rate of return of 8%, we gave an example, it'd be 72 divided by 8%. Okay? Or 72 divided by 8. And that will give us the number of years, approximate number of years for our investment to double. So in this case, 72 divided by 8 would be 9. Okay? So, very simple. 72 divided by 8, because 72 divided by 8, because we're getting an 8% return of our money, equals 9. So on average, this investment with an 8% rate of return will take 9 years for our money to double. So if we invested $100,000, we can expect 9 years later to have $200,000, right? So you want to be able to evaluate that, but it's going to take 9 years. Now, what if we invested in an opportunity and it's given us a rate of return of 4%? It'll be 72 divided by 4 will tell you how many years. So 72 divided by 4 is going to be 18. 72 divided by 4 is going to be 18. So it's going to take 18 years for your money to double, right? The 4% return is half of what the 8% return is. And if it took double the 9 years, right? So the higher your rate of return, the quicker your money doubles, obviously. But obviously you have to think about risk and everything else. But the higher your rate of return, the quicker your money doubles. And that's what we want. We want our money to double quicker, okay? We want your 100,000 to become 200,000. We want our money to double quicker. And this is another point too. It doesn't matter how much money you have invested, it will double. It still applies. So if you invested $1,000 at 8%, your money will double from $1,000 to $2,000 in 9 years. But the person who invested 1 million, their money will also double from 1 million to 2 million. So this is a very important principle. How much money you make in investment will be determined by how much principal you're investing and the rate of return. Also, how long time is a factor as well, right? Because if your money's doubling and you give it more time, it's going to keep doubling, right? So that's why time in the market is more important than timing the market. Okay, so the amount of money you're investing and the rate of return you're getting and how long you leave that money sitting. Those are the three factors. So the higher the rate of return, the quicker your money doubles. So you can imagine if someone is getting a rate of return of 18%, a rate of return of 18%. So it'll be 72 divided by 18, that's going to be equal to 4. 72 divided by 18, that's going to equal to 4. So that person's money is doubling every 4 years, right? So this is not complicated, as you can see, and it's something that you can quickly use to evaluate. Right? For example, the S&P 500 has an annualized rate of return of about 10%, right? It's like close to 10%. So if you put money into the S&P 500 index fund like VOO, you can expect your money to double every, go ahead, use the rule. Rate of return of about 10%. Do the rule of 72. So you should get about 7.2 years, so a little over 7 years. So on average, you can expect your money to double about every 7 years, right? So if you put $100,000 into the S&P 500, in 7 years, you could anticipate or expect it to be about 200,000. It should be double. If you put $1 million in, you should expect it to be about 2 million. And of course, it's an annualized rate of return. We know it's not every year it goes up 10%. For example, in 2023, the market returned 24% rate of return. The year before, in 2022, it was down about 19%. But on average, it's returned about 10%. Now you know about the rule of 72. You can be very smart financially. There's a flip side to compound interest, and that's when you owe. For example, you owe money to a credit card company because you're carrying a balance. And the credit card company has an APR of 18%. We did it before. 72 divided by 18 is going to be 4, right? But now this 4 means it's going to take you 4 years for the amount of money you owe to the credit card company to double. Because it has such a high APR, 18%. Every 4 years, the money you owe to the credit card company is going to double. That's assuming you don't pay anything. But even when you pay the bare minimum, a lot of people just pay the minimum payment, you're pretty much not even hitting the principal. And that's how the money doubles. And that's how the credit card companies make money, right? It was Albert Einstein, I believe, who said that compound interest is the eighth wonder of the world. Those who understand it earns it, and those who don't pays it. This is the flip side. This is us paying it. So you have a credit card and you carry a balance with a high APR. You see that, and you only paid minimum payment. You see that your money, the money that you owe the credit card company, is going to double. That's compound interest working against you. So you have a credit card company with an APR of 24%. How long will it take for your money to double? It's going to be the same. 72 divided by 24. And that's going to be 3 years, right? 72 divided by 24 is going to be 3, meaning that the credit card balance you owe on that will double every 3 years, assuming you just pay the minimum payment, which barely touches the principal. Pretty much about every 3 years, the amount you owe is going to double. So you owe something like $25,000 to the credit card company. In about a couple of years, if you're only paying minimum, that's going to be up to $50,000. That's why you pay the credit card little small amount and you see that nothing is changing. This is compound interest working against you. Right? The only way to fix something like that is to maybe get a zero balance transfer where you have a certain time period where and you transfer that to a card that have you transfer that to a card, you pay a little fee, and you have a time period where there's no interest being accrued. And that's how you could try to dig into it. Or you have to pay, you have to throw lots of money at it. Okay? So that is compound interest working against you. Okay? That's why it's so hard to get out of credit card debt, because of the interest. That's why it is so easy to make money passively when it's working on your side. When you're investing and you're getting 10, 12, 13% every year and you reinvest it. Okay? So hopefully, guys, you got something out of this. So the next time you're evaluating or just hearing about an investing opportunity, you'll be able to quickly use the rule of 72 and figure out how long will it take for my money to double. If there's people out there in your circle who would benefit from this type of content, send them the video, and I would appreciate a subscription on YouTube. And until next time, continue to command your money to grow. MD Investor, out.